Go stock up on those G-Wagons because 100% bonus depreciation is back. I'm kidding, but in reality, effective as of January 19th, 2025, bonus depreciation returns to 100%. Prior to that, it was down to 40%. 2024, it was at 60%. It had dwindled down the last few years, but it is now back to 100% and it's now permanent. Prior to this, the last couple decades, it's always been temporary. It's been written in through different codes and things like that. At this point, it's become permanent. It's going to be written into the tax code so that this will stay unless there's an act of Congress passed by everyone that changes it. So it's here to stay for a while. Now, what does this mean for you? Well, if you're a business owner or a real estate investor, it could mean huge tax benefits. And if you're not, you may want to look into potentially getting into some tax advantaged investment opportunities that you can use to leverage this, or it may just not be your cup of tea and you don't want involved at all, but at least you should know about it and understand if you can leverage it and how. So now direct your attention to the screen and take a look in here as we're going to run through a couple real life examples of what 100% bonus depreciation means. In this first example, let's look at a basic small business, a medical business that's buying a medical laser. This medical laser costs $75,000. Maybe they pay for it, but likely they finance it. Doesn't matter. The way they can deduct the $75,000 is going to be the same either way. So let's dive through this example. So some background facts and assumptions here is the medical laser was bought on July 1st, 2025, and it was bought for $75,000. Now, one other assumption we're going to make in this is that the overall tax rate was 25% between federal and state tax rates. And we're also assuming that the state that this business is in follows the federal guidelines for bonus depreciation. So those are some background and assumptions as we run through this. And now we're going to run through two series of examples. The first is what it looked like when bonus depreciation was in at 40%. And the next one is what it now looks like that bonus depreciation is at 100%, which is where this will land because it was bought and placed in service on July 1st, 2025, when the rules were bonus depreciation is 100%. So in the first example with 40% depreciation, they bought this at $75,000. Now, right away, they're going to allow them to take 60% of it as a bonus depreciation deduction in year one. So that's $30,000 they can break off and take in year one. Beyond that, they're going to let them divide the rest of it over 5 years, which is how this normally works. So after the first $30,000, we have $45,000 left. That's then divided over 5 years. So they would get $9,000 a year. It's actually broken down into months. So since in 2025, they would have this for 6 months, they get half of the bonus or half of the regular depreciation for that year. They're going to get $4,500. So in total, they're getting $34,500 in a depreciation deduction. What that comes out to, if they're at a 25% tax rate, is tax savings of $86.25. So they get $8,625 in savings from using depreciation on this laser, right? In year two, they're going to take another $9,000, another $9,000, another $9,000 until it's all used up in about year 6 when they use it up. Now, flipping over to what this looks like with 100% depreciation. Same facts and circumstances. They bought the $75,000 laser, but in this time, they get to take all $75,000 as depreciation in year one. So in 2025, their depreciation deduction isn't $34,500, it's $75,000. If they're at a 25% average tax rate, that's going to look like tax savings to them of $18,750. So that's a difference of $10,000 in actual tax savings, cash in that business owner's pocket from bonus going back to 100%, right? This is real money. This is real savings. This is real reasons to consider or make moves. Not the only reason. You want to look at everything involved when you're a business owner or anyone getting into one of these investment opportunities, but definitely starts to sweeten the pot when you look at the real numbers on these. All right, so let's dive into example number 2, which gets a little bit more hairy, but this is how bonus depreciation works with a cost segregation on a rental property. And we're going to look at the differences of what can happen now that it's back to 100%. So in this example, our background facts and assumptions is that we have a long-term rental. So it's a long-term rental. We're also assuming that this taxpayer meets reps or that they can somehow use the losses. In that point, the date in service we've got is still July 1st, 2025. We're going to say this property was purchased for $750,000. So the all-in purchase price plus renovations, anything like that is $750,000. Let's make an assumption that we have to break land out at 20%. So instead of the whole property being $750,000, it gets broken down on the return to say the land is $150,000, the building is $600,000. Now, you'll probably recall, if you follow along with us or have been in the rental game at all, that land is not depreciable. So land is going to stay on the books at $150, but that $600,000 you're going to start to depreciate. How you depreciate it depends on if you want to use a cost segregation or if you want to just use standard straight line depreciation. Let's assume that you're savvy enough to know on this deal, you would use a cost segregation study and break this up and get more of that depreciation accelerated into year one to get real tax savings. Well, when you do that, the next assumption we're going to make is that the cost segregation report is completed and it breaks out 25% of the property of the $600,000 of the building. It's going to break that out into 5, 7, or 15-year assets, things that we can take bonus depreciation on. So we've got now 150 in building value. We've got 150 in land value. We've got 150 in 5, 7, 15-year asset value. And then we've got the rest, which is 450 in building value. Now, this example uses a little bit of rounding and estimates in it, but it's going to be pretty close. We'd have to get the full official cost segregation report to be able to know this in detail. So the first one column again is 40% bonus depreciation. The next one's going to be what we look like now with 100%. So we've got 150,000 that's available for bonus. That's what's broken out into 5, 7, 15 years. Of that, if we were at 40%, then we have 60,000 in year one that we can use. We take away the 60, so we get to depreciate the building over 27 and a half years. We get to depreciate the rest of the stuff over 5, 7, or 15 years. So essentially we get another 12,000 or so in year one in depreciation. That's being pretty conservative with how much we could get. So that is $72,000 of a depreciation deduction in year one. If we take that at a 25% effective tax rate, that's tax savings of $18,000. So on this rental, your savings from the buying it and getting the depreciation of it with 40% bonus was $18,000. But what happens now that it's back to 100%? So you run the cost segregation report, it breaks out 150. You get to take all 150 in year one. Now you still get to take the rest of the building, the 450, you get to divide that over 27 and a half years. You get 6 months of that. So we get another about $8,000 in depreciation in year one. So our depreciation for year one isn't 72,000. It's 158,000. We then take that by the effective tax rate of 25%, and we've got real tax savings of $39,500, almost $40,000 in real tax savings. We're talking about a difference in this of $21,500 in actual tax savings from this change, right? So this is huge numbers. This is actual money. The 21,500, 22,000, that's a real difference. That's money that's yours today instead of getting it a little bit over time for the next 27 and a half years. All right, so hopefully that video gave you guys a quick example and understanding of what these implications mean as far as bonus depreciation being back to 100% for you as a real estate investor or a small business owner, and what you can do with that. Now, you'll need to understand some things. If you're a real estate investor, you're going to need to at least understand or work with someone who understands cost segregations. If you're a small business owner, you just need to understand bonus depreciation and make sure you're working with an accountant who understands it and is giving you good advice on it. Make sure they're implementing it right. But these are two tools that you can use to get real money back in your pocket today. Start to get that, start to earn your return on it versus waiting over time, losing out on this over the next several years. Guys, hopefully this was helpful. If you have questions on it, feel free to comment or give us feedback and we'll respond to those questions as best we can.